doing? What's that?
Getting better, man. Having to drive everywhere.
How old are they now?
15, 13, and 11.
I'm just slightly ahead of you. 17, 15, 11.
At least one of them drives.
Good morning.
No.
Okay.
My neighbor comes up.
He's working on it.
Okay.
I told he just started working at the zoo,
Oh, okay.
but he's only working. I told him he has to pay for part of the insurance.
Same thing.
That's the way it is, right?
So far, nothing yet. so,
Morning, George.
yeah, it's crazy. Morning.
But it's no, it's in fact it's.
Morning.
Oh, you got my myself. Yeah. So I can. Yeah, I'm gonna get back a little bit. You want to, well, just how you feel.
Casey, I think everyone who's coming is here.
Oh, second.
Jack, no.
Okay. All right, we'll call to order this meeting of the combined pension plans, police and fire, and employee retirement system for Thursday, May 4th, 2017. Roll call, please.
Okay. Trustees Martin,
Here.
Coulter,
Here.
Mead,
Here.
Pichet, Lynch, here, and Chair O'Loughlin.
Here, thank you. First item of business is the report to both Luna sales.
Good morning.
Morning.
As I usually say when I start off this conversation, I will hit the highlights, and based on your time constraint and questions, we'll dig as deep as we'd like. But I think the highlights are usually the best. I'll cover briefly on my views on the markets, and then I'll go into the specific portfolios, both on the bond side and on the stock side. So first, with respect to the markets, so much has been written in the last couple months that we are now 8 years into this bull market in stocks. It's hard to believe. March of 2009, markets in the economy were flat on their backs. Stocks had fallen more than 55% from their highs. Every time you felt like you watched the news, it was more sobering, and prices found lower lows. Since then, markets compounded at 17% annualized. I think even the most optimistic person in March 2009 would have never expected a 17% annualized return. Which then lends itself to the question of 8 years into this bull market. It's easy to look in the rearview mirror and have very thoughtful commentary. The more important thing is to look out for a pension fund at least 2 to 3 years forward, and certainly much longer given the nature of your assets to meet liability needs. But as you look out 2 or 3 years forward, I think there's still pretty good legs left in this market for a couple of reasons. One is, despite the fact that it is now 8 years old, and when you look at bull markets in history, this is getting to be one of the older bull markets and quite robust. But I remember making this comment a couple years ago. Bull markets don't die of old age. They die of, thank you. They die of, or they fizzle out on too much euphoria, bad decisions made either by the Federal Reserve or policymakers in Washington, D.C., valuations or stock prices relative to profits and cash flow that are priced for sainthood. And I think the respectable news still today that the punchline would be for the assets where I manage total portfolios, I think you can still realistically get 7% compound annualized returns for the next 2 to 3 years in stocks, maybe as high as 8. Some of the reasons why: investor sentiment. I'm more of a contrarian. When everybody's euphoric and loves the market, that's the time naturally to be more skeptical. And sentiment, even as of this morning, is not overly robust. We get too finite with stats in our industry, but one that sticks out to me is more than 60% of investors would either classify themselves as bearish or neutral. More than 60%. That's actually a good thing, because stock prices go higher, we know, on mistrust. And this is still a relatively mistrusted bull market. That's a good thing as you try to find individual securities to generate returns for your portfolio. The valuations, what I mean is the prices you pay for a security based on its profits and, even more important, its cash flow, is still, I think, to use the word again, respectable. Maybe not so much on profits, but more importantly on cash flow. I think you still have some legs left in this market based on the prices you're paying for future cash flow a company's generating. 2 more quick ones. The macro environment is modestly improving. It's not on fire, it's not gangbusters, but it's modestly improving. We're getting corporate profit reports for the first quarter that are as good as I've seen in 5+ years. That's a good thing. And then finally, inflation is still low. Inflation's 2%. To me, the magic number on inflation is when it's 3.5% or 4%. Then you've got to be worried about what it does to interest rates, the economy, profits, and then hence ultimately security prices. So 8 years into a bull market, I get a little page happy in the book, put a few pages in there. That's really the takeaway I think on the market is respectable 7%, perhaps better, compound annualized returns in the next 2 to 3 years, particularly based on how much cash flow companies are generating. And in that type of backdrop, it's still hard to find asset classes that are going to give you better than that 7 to 8%. High-yield bonds are yielding about 5.5%. A 10-year U.S. Treasury yields less than 2.5% today. That's, after inflation, that's where I think actually there is potentially more risk in the market. Now, we will get that proverbial 10% hiccup in stock prices. There's a page in the handout that I don't need to go into detail, but if you go back for more than 25 years, within any single calendar year, intra-year, right, within any single calendar year, the average sell-off is about 12%. So we're due. We haven't had one in a year and about 5 quarters exactly. So we're due, but I think as much as you get that question, you as a long-term investor, you more than anything, you just fight through it. By the time you recognize it, it's halfway over. You're going to be selling stocks when they're down 5% and then trying to figure out when to rebuy. But what you try to do when the market's down 10% is, there can be good companies that maybe fall 15%, and now you have a better entry point to buy them. I think for the long term, that's always how I've thought about those 10% hiccups in a market. Good luck trying to time them. It's nearly impossible, but you do get entry points into specific securities, a stock or a bond, that allows you to take advantage of it. So those are the best thoughts on the market, not in the CNBC terms of what's going to happen in the next week, the next quarter, but importantly for you, what's going to happen in the next 2 to 3 years as you try to make a thoughtful decision on how you deploy your capital in your portfolios. The 3 portfolios, I can sum them up pretty quickly. The 2 bond portfolios are doing exactly what you want them to do. One is a core fixed income portfolio. I've described this to you in Detroit terms as it is 87, 88 octane. It's your shock absorber in the portfolio, and it's doing exactly what you want it to do, and it's outperforming. The 91, 92 octane bond piece of the portfolio is that high yield piece, and that has done exceptionally well for you, particularly in the last 14, 15 months, as high yield has been a very positive asset class. In baseball terms, in high yield, where we are in the cycle, I think we're somewhere in the top of the 7th or middle of the 7th inning. There's still some legs to go left in it, but you did see absolutely outsized returns in the last 5 quarters, and that's more commensurate with it. Last, we'll have a little more discussion on the U.S. stock value portfolio. As you recall, at your last meeting in the month of January, I think you made the exact right decision to put the strategy on probation or watch, given its returns in 2016. It's now May of 2017, so 16 is a bit of a distant memory. But as a reminder, the weaker performance in 2016 really occurred almost exclusively in the first quarter. Since about the midpoint of 2016, the portfolio has recovered quite well, and it's continued to year to date. I like to quote Brian because I think he had the most thoughtful comment when he said, "Beware of managers who come in with up-to-date results." But I think that's a good discussion for today, because as I look in the first quarter, we outperformed, and as I look at the month of April, we've continued to outperform, where we're anywhere from a 1.25% to 1.3% ahead of the benchmark in 2017. So I think the decision you made in January of this year to put the strategy, January, February, to put the strategy on probation was exactly the right thing as a fiduciary within the portfolio. That's key. I mean, I've said before, I get to sit on your side of the table, and it's pretty tough, right? I sit on Beaumont's investment committee. I chair the Detroit pension out of bankruptcy, and it gets really tough. It's the same thing as a stock investor. When do I sell or when do I buy a stock, especially the sell decision? If it's been a good long-term performer, but maybe it's stubbed its toe, and that's important. A little more news on the large cap value side. One of the portfolio managers, his name's Adam Leboff. There's 5 analysts, just by way of background. 5 analysts. Average experience is about 18 years, so they're pretty seasoned. There's a portfolio manager, Art Berry. We hired him in 2005, so he's been on the case for more than 10 years. The other portfolio, Adam Leboff, who came back to us in 2014 when we were looking to fill a slot He's going to work at Raytheon. Good guy. I like him. But he wants a different change in lifestyle. So he's going to work at Raytheon internally within their pension group. Different change in lifestyle, a little more sanguine, I think is the best way to describe it. What we're simply doing is we're being thoughtful and we are figuring it out. Out of the two, I won't embellish this. Art Berry, who's there, let's call him Portfolio Manager A. Adam was more junior, but still critical, very important. You don't diminish anybody who's gone on to a different change in career, but he was more secondary in the process. And for the time being, we are not going to replace that position because of the experience of the analyst and how long Art's been on the team. I don't have the perfect answer. I wish I had the perfect formula in terms of is it better with one seasoned portfolio manager with a deep team of analysts or two. If I had the perfect answer, the same way if I had the perfect answer for picking stocks, politely said, as much as I like the city of Ferndale and have worked with you for 20 years, I'd probably be on a beach if I had all the answers. But I do think that as we think about this, one very dedicated, seasoned value portfolio manager with the analyst, if I had to choose, I think that's probably the best approach. That's what we're going to pursue. It doesn't mean it's permanent. As I said, you don't have the perfect answer between two portfolio managers or one portfolio manager. We could debate this for too long, except the fact that I've seen it work well both ways. I've seen it work incredibly well on my large cap growth team with one portfolio manager and a deep team of analysts, and that's how we're gonna proceed. If we think we want to rethink that, we'll change and we'll go get somebody else. The firm has deep resources. We run $250 billion. So in that spirit, I think we made the right decision to put the strategy on probation. It's not as if when you get put on probation, you suddenly decide, oh, I'm going to try harder and I'm going to skate harder because I spent 2 minutes in the penalty box and now I've got to come out. But the decision was right. We're back again outperforming in 2017. The inflection point really came about mid-year 2016. And I put a lot of pages in the book, but this is really, I think, just a conversation. Your long-term results and value. If I had to show you just one page, I'd show you on page 7. And this is in the general employees book, but it's the same page for police and fire. And it just says, how's this portfolio done over the last 15 plus years? And it's done quite well. But along the way, sometimes you do underperform. The good thing is you have a long enough runway with this strategy that when it does underperform, it gets it back. I saw it in parts of 2010 and 11. I've seen it in years past. I mean, that's a good thing is you have a long history where you've been a long-term owner. And when it does lag, it gets it back. I think as a fiduciary, you've done the right thing by putting it on probation. My last piece of advice to you would be this, is you've done the right thing. Check it out when second quarter's all done in the spirit of beware of managers bringing in updated numbers, but you're ahead year to date. Consistent with the long term. I think that the formula is going to be right, but I also say very candidly, as my fiduciary duty to you is you never know, but at least when it has lagged, it's come back quite well. And you'll get a good glimpse of this in June for did it keep it up? Did that decision that you made to put it on watch or probation thoughtfully is the right thing? And as we look into this calendar year, as it's done in the past, when it lags, it's once again comfortably outperforming its index. So I'm happy to take any questions, either from the board or from Brian, George, and Tom.
I guess I would just ask, if I could get it out without coughing, I apologize. I was just a little surprised that in your overview, from a non-financial expert perspective, it seems to me that something that's been a big impact on the market has been the November election and the market's perception that there'll be tax reform and regulation reform and a very positive feeling from a lot of businesses about that. And you didn't mention that. Is that too short term? Is that because to me that seems like really significant? And then because my question is, do you think that good feeling will last, or is that just a short term thing?
Sure, and I didn't purposely skip it.
No,
because we've been certainly so inundated since the November election on taxes, healthcare, regulation, you name it. The shortest answer, I think, are 2 points. Number one, from a micro perspective, as I and my colleagues build portfolios, they are very micro-driven, stock by stock, bond by bond. We pay attention to what's going on politically, but more often than not, it's a individual thesis in the company. I think time and time again that is the best way to create value for your clients versus trying to make a educated guess on what's happening in Washington and can I take my best thoughts and apply it to a portfolio. My experience is more often than not your ability to add value is quite diluted. So to the election, these portfolios are very bond by bond, stock by stock built. Having said that, that's the most important thing. Second is from a macro perspective, the outcome in November, I do believe was more of a game changer than not. It did begin to move the pendulum in the right direction on regulation, which had gotten a little excessive, and then the potential for some type of tax reform, particularly at the corporate level, because the U.S. is not moving in the right direction on being competitive in corporate taxes in particular. So I do think it was a game changer that has the potential to extend the cycle, and stocks responded quite well, particularly the more cyclical small caps, banks, etc. And for not trying to pay too much attention to politics as it relates to specific portfolio building, this one was more of a game changer, which I think extended the cycle.
Your answer was longer than the tax reform document. So.
But it's amazing, like the winners of November and December kind of been the losers of changing the February market.
Oh, is that right?
It's the euphoria that bid up a lot of small cap stocks because they would traditionally benefit the most from tax reform because they don't have, 30 tax attorneys on staff to be able to shield them that, a large cap company has. Right? Any deregulation of banks, any, backing off on any of the regulations that have been implemented kind of post-crisis, bank stocks, insurance stocks get bid up. And then you look, for example, one of the worst performing sectors, the S&P 500 in the first quarter of 17, financials. So the market's moved higher, but the outperformance for certain sectors has come back now in line where it's just been more of a lateral move up and everything's been bid up. And that excess that you had in November and December has kind of fallen off.
I think we'll see more of, if the news, as one person said it best, if you don't get this deregulation or these tax cuts, you get Trump without the good stuff. And the potential for the good stuff, I think, is still in the works, especially in terms of how people interpret regulation. That could be good for the banks. Nobody's going to repeal Dodd-Frank, unlikely. But when a regulator comes in a bank, do they spend 130 days there or do they spend 30 days? Do they give them a ticket for going 2 miles over the speed limit or do they let them go 8 to 9 miles over the speed limit? In the last couple of years, it's been you get a ticket for 1 or 2 miles over the speed limit in many industries. And I think how regulators treat business has the potential to be much more friendly.
First time I've ever heard the phrase 9-year fine, 10-year fine in some financial context.
Thank you.
Any other questions? Is there a motion to accept the report?
So moved. That's the second.
Yeah.
That was the
That's a
second.
second.
Yeah.
Oh, man.
Is that for both systems?
Yeah.
Okay. All right. Okay, trustees Coulter,
Yes.
Martin,
Yes.
Lynch? Yes. Mead?
Yes.
And Chair Loughlin.
Yes. Thank you. Next item is the ANCO consulting report for this quarter.
Good morning, everyone. Just wanted to preview Jeff Cutler from Vontable, the International Equity Manager for the Fire and Police Retirement System, will be in here today to talk about their perspective on the international stock market, which is where a lot of money's going these days, has been and probably will continue to go there. All right, well, as usual, page 1 of my report is the market update and overview. Dave gave us sort of the qualitative part of that. What we see on the statistical side of it, just to summarize all that good information on page 1, is small cap, micro cap stocks continue to attract a lot of attention, just like emerging market equities do. Historically, those are the most risky parts of the global stock market. As Dave mentioned, high yield bonds have gone off the charts for the quarter, for the past 5-6 quarters. Obviously, the most risky part of the bond market. So we're seeing a lot of uncertainty amongst investors. As Brian mentioned, you saw the sectors, the bottom of our chart there, the sectors that did best in 2016 are the sectors that are lagging in 2017. There's a great deal of indecision amongst investors. That is symptomatic of the end of a nice bull market. A lot of investors are chasing returns. There's no sector in favor from one quarter to the next these days, a lot of rotation. So it helps to have a diversified portfolio. The news, if we go down to page 2 of your report, and I'll start with the general employee retirement system, up 3% for the quarter, which, you know, historically speaking, 3% in any quarter is a very strong rate of return. That was better than the policy index. The trailing 12-month number ending March 31st, the plan earned almost 9%. So the results continue to be very strong. As you'll recall, we took steps a few years ago to de-risk the general employee retirement system. It does not need to grow. It does not need to take the kinds of risks that are going to lead to the kinds of growth that most pension plans in the United States need today with their very poor funding levels. You'll see a lot of risk-taking, as we are seeing with some poorly funded retirement systems. But both the general and the police and fire retirement system for Ferndale are in a preferred spot relative to the U.S. public fund universe. So when you look at the peer group numbers, just the explanation behind the numbers in parentheses, I expect us to not be in the first percentile except when you see the markets falling backward, because we are in a risk-averse position today. We are not in a high-growth, high-risk-taking position with the general employees. And I'll comment more on the police and fire. Well, I'll just talk about it right now. The police and fire itself is in excellent shape compared to other police and fire retirement systems across the country. And obviously, we did take steps to de-risk reduce the high-risk exposures in that plan as well. But let's just I'll just finish up the general employee retirement system. The low volatility index, it's an index, so we got 5.2%. If you want to compare it to the broad U.S. stock market, that was up 6%, the S&P 500. Keeping in mind, the low volatility index is only 100 stocks versus 500. And in the S&P 500, the sectors that did the best, if you look at large, mid-cap, small cap, it was the mid and small size companies in the index that led the way. The large cap value portfolio had a good quarter, up 3.9 versus a benchmark that was up 3.3. The fixed income portfolio, which is focused in the middle of the interest rate curve, it's more in the what we call the intermediate duration, so it has a little less sensitivity to the any increases in interest rates, which we've had two in the last 6 months, are doing well. That portfolio, however, is heavily exposed to corporates. There's not a lot of lower yielding government and treasury securities, so that helps the outperformance during this continued low interest rate environment that we're in. The high yield fund, well, a high yield fund is acting more like a stock fund, okay? And that is one of those funds that when things get going the wrong way in the stock market, we'll see this fund not only look more like a stock fund in terms of its loss, but there's a lot of money in there. The historical difference between the yield on a high yield bond and an investment grade bond is nearing a record low. It should be 4 or 5% difference, and today it's way down here. So Dave commented that he thinks it's in the seventh, or the high yield market's in the seventh or seventh and a half inning. I could tell you the bases are loaded, and the fourth man in the lineup is at bat right now on the opposing team for high yield. Okay, a lot of bond market pundits say high yield is going to be great. It's going to continue to go great guns like the stock market has because there's no default risk. Well, most of the people that are following it never even went through a credit crisis like we had in 2008, and they don't remember that high yield bonds have other sensitivities besides default risk. So stay tuned. We've taken steps to de-risk that over time and reduce the exposure for the overall plan on that. The last portfolio is the UBS Trumbull portfolio. That's the real estate portfolio, 1.15% for the quarter. Good return. We look at this relative to what the bond market is doing. It continues to outperform as it should, not only near term but long term. Less sensitivity to interest rates than the bond portfolio, and superior yields to what you can get in the fixed income markets these days. The fund itself, in comparison to the benchmark, the NCRE Fund Index, looks a little weak, but the reality of it is that benchmark that we use, because investors cannot buy an index, there's no commercial real estate index that's available like there would be for stock or bond investors, is actually a real peer group. So these are all widely diversified commercial real estate funds throughout the United States. Many of them are using a great deal of debt or leverage in the funds, and so the returns on those funds get magnified when the markets are moving up as they have for the last several years. There's nothing fundamentally wrong with what's going on. In the portfolio, this is what we call a core, or the most conservative approach to commercial real estate. This fund's results compare, if you take the core property funds out of the index, they're very competitive, okay? And most of the return today is coming from income. There's not a lot of price appreciation left in the core commercial real estate space. So I want to comment on two other pages for you. go over to the police and fire. So page 7 of your report, excuse me, well, not in your package, but page 7 of my report. Lower left-hand corner. The bar chart. This is just the compliance asset allocation policy compliance chart, and this tells us exactly what we like to see. All of the allocations are in line with, or very close to the policy indexes, which is the solid black line in each bar chart there. Then the last page that I'd like to comment on is page 8, conclusions. So just to wrap up for the general employee retirement plan, a very, very solid quarter. Outstanding risk-adjusted results, okay, over the last 2, 3, 4 years. And if we put you in a peer group of U.S. public funds and compared your results on a risk-adjusted basis, you'd probably be in the top % on that, even though you're already in the top quartile or top 10% on different years on return only. But the level of risk is much less than your typical pension fund as well. So everything is working according to the investment policy and according to the investment strategy and the expectations for that. Talk about item 3 there. The large cap value portfolio is on probation through the end of June. The results for the first quarter this year, were above expectations. We look at the last 6 months, the last 9 months, the last 12 months. The trend is encouraging. Okay, I'll talk more about other issues which are not encouraging. Okay, in a moment. The bond market is a lousy place to be these days. That's why people are buying high-yield bonds. They're buying stocks. There's a lot of investors that have jumped out of the bond market who shouldn't have, and they're in the stock market. And so those kinds of scenarios usually end badly. We saw a lot of that in 99, 2000, and 2001. We saw a lot of people who got out of the markets in 08 and 09 and never got back in until the last couple of years. And, you know, they're doing exactly what they tell us not to do, which is buy high and sell low. So that doesn't end well either. But we're doing exactly what we should be as an institutional investor. And I'm very comfortable with where we're at relative to extraordinary stock and bond valuations today. All right, we talked about UBS Trumbull. All right, let's talk about Loomis Sayles Large Cap Value Team. All right, there's a memo that Dave sent you, and that was following the memo that Brian and I had sent you a couple of weeks ago when we learned that the co-portfolio manager, Adam Liebhoff, had left Loomis Sayles. Now, what's significant is that the portfolio manager, Warren Kuntz, left in 2014. Warren's track record was there before David became the representative here, okay? So we're looking at 2 very significant departures in a short period of time. And Dave didn't mention any changes on the analytical team, so we don't know if there have been. But I could tell you that, what's that? That's good. ANCO has met with the people from Loomis Sayles, okay? And the ANCO position is no confidence. Seek other alternatives, okay? Loomis Sayles Large Cap Value product is not on the recommended list, okay? There are many, many others that are, that have been fully vetted, that have stable personnel, that have very competitive risk-adjusted returns for the last several quarters and years. So the decision that both boards have to make is what to do about this. And you have 2 decisions today. One is continue with the probation and hope that results in the second quarter will meet expectations and that they will meet the terms of the watch list, which means they have to outperform their benchmark, they have to outperform their peer group, and they have to do it on a risk-adjusted basis as well. Okay. The second decision is just cut the cord today. Okay. Rats are jumping off the ship's taking on water. Seek other alternatives. We are prepared today, in the interest of full disclosure, to give you the due diligence report. We have already taken, as we have for other clients who worked with the Loomis Sales large cap value product, the necessary due diligence to find a replacement manager. So you have that alternative, you have the alternative wait and see, but you still must evaluate the rest of the facts. Performance is one thing. How that performance was achieved is not going to be the same way it's going to be achieved in the future because you don't have the same people running the portfolio going forward. Okay? So those are all the decision-making inputs, and that applies to both boards. So I'll take your direction. We can come back to that when I finish the police and fire report, or we can talk about that right now.
Does anybody have to leave before we have a quorum? Okay. Okay.
Okay.
But, well, I don't know if we want to talk about it now or later.
Can we do police and fire report
Yeah.
first, and then discuss it?
Sure. All righty. All right. I'll start off on page 2 of my report for the police and fire. Police and fire had a higher return for the quarter, up 4.03%, which was nicely ahead of the benchmark. The primary driver of the outperformance was the international stock portfolio, which you probably concluded. The higher risk profile in the police and fire retirement system warrants the higher risk in the international equity arena, and that returned 11.6% for the quarter from Vontobel, with a benchmark that was up 9%. Okay. The overall results were excellent. In the last 12 months ending March 31st, the police and fire retirement system has earned 9.9%. So looking very good on a total return, on a peer group, and on a risk-adjusted basis as well. All right, page 7, a little bit of over-allocation on U.S. and international stocks, a little bit of under-allocation on the fixed income owing to weaker results. We've seen this before. Stocks outperform, the allocations go above target, bonds usually lag in that scenario. And we have a little bit of cash, which is always good, so we keep those monthly pension checks flowing. Let's go to the last page, 8. We talked about the summary for total fund. Go to item 3. The Vontobel International Equity Portfolio has struggled. It's been a tough year. Trailing 12 months, tough 2016 in general. Good first quarter. They too are on the watch list through June 30th. As I mentioned, I did invite their client relations person, Jeff Cutler, to be here today at 7:30. I don't see him. Oh, is he? Okay. All right.
Yep.
Okay. So That wraps up everything for the police and fire report too. The same discussion on the Loomis Sales large cap value portfolio is on the table though. Same comments and observations. And any questions about the reports, the managers, the individual portfolios? Okay.
Motion to accept reports.
So moved.
Support.
Okay. Trustees Coulter?
Yes.
Martin?
Yeah.
Lynch?
Yep.
Bede? Chair O'Loughlin?
So you want some direction on your question you posed to us, correct?
Yes. Yes, please.
So let me ask you this question. One of the things that David impressed and you highlighted in your memo was that this is it was a co-person, right? Co-manager, thank you, who had only been there since 2015, not only, but so a relatively short time. Does that influence your concern? I mean, obviously, if there was only one manager, that would be more concerning. Does that influence your concern? Should it influence our concern?
Well, it does influence the concern simply because that's the way Loomis Sales decided they would always run the team. And now they're telling us they haven't decided if they're going to continue to run it that way. So it's uncertainty created by departures, it's uncertainty created by poor performance, and now it's uncertainty decided by lack of decision making.
So, George, you just have to help me out because I hold several different jobs, and it's not unusual for people to leave occasionally, and stuff happens. Although it does seem different that in the financial world, people will stay for a long time, and that seems to be part of the value with how long they've been there. We hear that all the time, average length of stay of the managers and all of that stuff. So it's a little hard for me. There's a part of me that says, well, guys leave or people leave. So I'm not sure how to weigh the significance of that, to be honest with you.
Yeah. Well, a lot of people weigh the significance of that with their conscience, their level of confidence. Okay, it's probably fair to say that there's a high level of confidence in Loomis Sales. They manage different portfolios for both plans. But in this case, we're only talking about the large cap value portfolio, and what we're looking at is, do we have confidence in what's left over? Art Berry is the person now, and so he has been the person along with Adam Leboff since 2014 when Warren Kuntz, who was the person, left. And so we look at the results that Art and Adam have achieved, and they haven't met expectations. This quarter, I've always been the first one to tell clients one quarter doesn't make or break a manager or a strategy, investment policy. Can only say things are moving in the right direction. And so my advice to the board today is let your conscience be your guide on whether or not to wait and see through June 30th or to take a preemptive measure today.
How long would they have been on probation as of June 30? Would that be a year or 6 months? And just to clarify, it is moving in the right direction, correct? So far,
Yes.
reading? Okay. I would be comfortable keeping in probation until June 30 and reevaluate.
I agree.
I mean, I guess that's right. You two have been on the board longer than me. but
Same.
My level of confidence is fairly high in the organization, and we put them on probation when things start to look concerning, so it's not like we haven't taken action, so.
Right.
I'm with that discussion.
All right, so we need a motion to keep them on watch list and reevaluate in June.
So move.
Support.
This for both plans? For general?
It can be if you wanted. Why don't we do them each separately, just in
Yeah, we
case?
probably should.
We should do this one separately, please.
Sure.
I supported that, Marnie.
I can't make the motion on the employee then, because I'm chair.
Oh, you are. I will make the motion.
So you have to support.
And I support.
There's only three of us.
Okay. For the employee retirement system, Trustee Coulter,
Yes.
Trustee Lynch,
Yes.
and Chair Martin.
Yes. All right, I'll make the motion for the police and fire.
I'll support.
Okay. Trustee Coulter,
Yes.
Trustee Martin,
Yes.
Trustee Mead,
Yes.
Trustee Lynch,
Yes.
and Chair O'Loughlin.
Yes.
Quick observation. I put my fiduciary trustee hat on, do my best to remove my bias, which plainly acknowledge. I think the June 30th is the right decision from a fiduciary standpoint. Proverbially, you can't unring a bell twice a month. And just for clarification on facts, Mark Berry's been here since 2005, so his fingerprints are all over the portfolio for 12 years. Doesn't diminish the fact that Adam departed for, I think, good reasons for Adam. But for the conversation of I and my firm's inability to make a decision, I wouldn't characterize it as that. I'd characterize it as we're being thoughtful. We're not going to rush to the altar, because if you do that, I've seen it done wrong. You feel like to satisfy clients and consultants, if you had to, you have to have to. And then if you don't do it right, sometimes, I'll tell you, no two portfolio managers, speaking as one, ever think exactly alike. And if you do try to rush the process, and you don't do it right because you rush it, the outcome is even worse. If, and hence, the best decision right now is a very seasoned portfolio manager who's been on it for 12 years will be the single portfolio manager. Candidly speaking, my duty to you, I think that's the best decision right now. And we'll be thoughtful. Because no two PMs ever make it right. And the worst thing you can do is, for lack of better words, this isn't a good investment term, is jam it. Right? That will not serve you and mine well.
So, so David, you took off your biases and you have this objective hat on now. So you're sitting on the Beaumont board, right, which you chair, or the finance committee. What are the things that you would look for in a situation like this? If a manager leaves or a co-manager leaves, what are the things that you would concern you versus less concerning?
I think Brian and George are doing the right thing. They're looking at it qualitatively and quantitatively. So you have your quantitative metrics, which are house performance, and you can slice and dice performance any way you want to look good or look less than good. The qualitative ones are tests. We've had more turnover than I'd like to see. So, as a result, you're making the right decision, because it is a applied art. It's not a hard science. You have to make this decision. You can assess it in June. If performance hasn't continued to improve, well, like we said, in police and fire terms, I'll be here.
So we'll come back with the August meeting. And this is, part of what we do a lot behind the scenes is, a lot of work that may end up being no action, but it's important to have it on, is, June 30 will be the commencement of, sorry, I just struggle with that. Like, commencement means beginning, but I was thinking, like, commencement is like graduation. What do you mean it's the beginning of something? So June 30 will be the end of the current probation period. So what we'll have for the August meeting is a search book. It's an evaluation from a qualitative and quantitative standpoint of the strategy as it stands as of June 30, as well as some other candidates. Now, one of the easiest things that we can do is to go back to a bench of, say, 15 different market cap value strategies and say, give me the 4 that outperform 1 year, 3 year, 5 year, 7 year, 10 year. And I can promise you that those 4 would be really easy to say, buy Loomis, and we're gonna go in this direction. And inherently, that's one of those decisions as a trustee that in the next couple of years you go, what's up? This manager's performance is terrible, and it's because of the cyclicality of performance. So instead, it's a more thoughtful approach of like, here are other candidates that fit in your portfolio that in today's environment would be a good opportunity. Is there a better option? Is there not a better option? One of the things we want to make sure that we arm you with is the information, to make the right decision. And equally as important, if someone wants to question that decision 6 months, 6 years down the road, that you've got the backup, that Tom can nod his head and say, from a fiduciary standpoint, you've fulfilled your duty in making this decision. Stay, go, continue probation, whatever it may be. So we'll have some more kind of clear qualitative and quantitative data for you guys at the August meeting.
Thank you. The next item is informational on the memos. Is there any discussion on the memos?
Mr. Chairman, before we leave the investment reports, I have 2 other items,
Okay.
please. One is the other part of the memo that we sent to the board on April 24th. That's regarding personnel changes at World Asset Management. You recall they had some pretty significant changes in 2016, and in the past couple of weeks, they had another very significant change. I want to say that change has no impact today on the portfolio that World manages for either retirement plan. The change that I'm talking about is their head of fixed income, indexed fixed income, left the firm. Okay, the portfolio that both plans have is managed by the equity team, and that U.S. equity team remains intact today. However, given the series of personnel changes there, we are very mindful of that, and we'll continue to try to stay as close as we can to other organizational change, such as they may or may not be. Okay. The last item that I had today is Jeff Cutler's here. And I had invited Jeff in because, as he knows and as you know, Vonnegut is on probation through June 30th, and I felt it'd be timely to hear from Jeff on the portfolio, which had a great quarter, which is good to see, and to talk to the trustees about what the firm sees going on in the international equity world today. So hopefully we can take care of that.
Thanks. Sure.
Okay.
Bye, Dave.
See you, Dave.
Yes.
Morning.
Sure. Well, you've certainly helped tee things up for me. I'm kind of glad I got a chance to just listen in a little bit there.
Thank you, sir.
This is one of the endemic issues in our industry. I've been now in the industry since 1984, and I personally, including my experiences now with Von Tobel, have lived through 4 different successions or changes or these issues that deal with turnover on investment teams primarily. So I'm actually thinking about my 3rd career hanging out a shingle as a consultant to firms that go through these changes. And if I may, just make a couple of comments, hopefully help you inform your decision too, because it's certainly relevant to us too. But I mean, a couple of things. One thing, in the past, with the 3 other firms that I was with, they no longer exist. They fell apart. And I think that's one of the benchmarks, if you will, or something to look at, is what's happening at the firm level, right? Typically what you see is the culture is shattered, and it starts to fracture on all levels. Morale goes through the floor. Nobody's working hard anymore. Everybody's looking for jobs, and that's just the rest of the firm. I mean, the investment team is distracted. All these things. These are all human cultural issues, but they have a lot of impact on the viability and the future of these firms to survive. But with that said, good firms do survive, and there are many firms in our industry that have been around for 20, 30, 40 years. And as you pointed out, well, turnover occurs. People do things for different reasons. You hope that they're the right reasons. They're moving on with their career. There's an opportunity, things like that. But when there's hostility, or there are other issues that are infecting the firm, that's when you really see the knock-on effects going forward. How do you see that and measure it? That's difficult, frankly. You can start just talking to the grapevine sometimes to hear what's really going on inside a firm. I mean, that's so. If I may then sort of bring it back to us. So one thing that I've noticed with Von Tobel, and I say this now as somewhat of an observer too, is I've now been with the firm for 10 years. I was hired to help build out our institutional business with plans just like yours. That's been my only experience in the business. And I value the mission and the of serving plans like yours, and that's why I signed on with Von Tobel from a cultural standpoint. It was very clear that that's what they wanted to do in building out the business. And what I have not seen, clearly, is any fracturing of the culture. And, to use the trite term, stability is, it's very trite. It's used often, but it does speak to certain things. So in our case, we have a parent company that's a family-owned business. It's been that way since the beginning, over almost 90 years ago today. Family is just owners. They're not managers of the business, but they are committed to it. And when we had our change just about a year ago, the first thing that they did was come and say, we will back you up, expecting that we would lose assets, revenues would be affected. They said, we're going to make sure that the investment team is well capitalized, and we will stand behind it to keep the team intact. So that's what's occurred in a nutshell, and I'll just elaborate on that just a little bit further. But I just want to take a step back. I mean, we started our relationship almost 4.5 years ago, and we just want to say formally we're very grateful and thankful to you. One, for, of course, hiring us from the beginning, but also now, and to George and his colleagues, to maintaining some patience and, what we think is, a more mature view of what happens in the industry and giving a firm a chance to work it out. So we are very grateful of that. But a lot has happened in the markets, too. And, George alluded to having a very good recent quarter performance, but we'll look at what's gone on for the last 4.5 years. And I think we can very clearly say to you that we've met the performance objectives as we laid them out, and I will reiterate, what those are in terms of what your expectations should be. But just to remind you of why you hired us. I mean, I think one of the benefits of having these meetings, and I know that it's been a little over almost 2 years since I was here last, is really just to remind folks, what were you looking for? Why us? And I know, the international equity asset class is one that's important. It's a growing asset class. It's a place where you can still find the type of returns that you'll need to give your beneficiaries that dignified pension that you're looking to provide for them. And we are dedicated to doing just that, both in the asset class, and we only manage long-only public equity company portfolios across the globe, in this case, just non-U.S. And we do that by investing in what we call high-quality growth businesses. And these are essentially the mom-and-pop, long-standing, good businesses that deliver products and services that we all use, and you're seeing this sort of development, around the world as well. And the goal is to, of course, outperform the benchmark, but with less risk. And we wanted to see that over what we would say is a full market cycle. 4.5 years isn't typically, considered a cycle, but nevertheless, you've had some interesting experience in these 4.5 years. There's been what we would see as a couple of mini cycles. But, the goal is not unique. Every firm essentially stands up here and says something probably similar. No one comes in and says we're buying lousy businesses at high prices. It's the execution that matters. And this is where you can connect, the investment expertise to the culture in a firm. And we've been applying this approach since we started managing this strategy 27 years ago. And we've had 2 different changes in the senior level portfolio manager position over those 27 years. So to get to the specifics of this and give you a little bit more background on it, page 4 is probably a good place to start. It's an organizational chart of the team. But just to remind you, Rajiv Jain was the Chief Investment Officer. He resigned February 29th of 2016. It was an amicable departure. Rajiv had been with the firm since 1994. He actually came in as a senior analyst and a co-PM to some degree in a portfolio change at that time. And then in 2001, he assumed the mantle and leadership of the team. So he was involved effectively in 2 different changes to the firm. Mind you, the team that has been managing this firm, 2 individuals primarily, have started the firm in 1988 and are still with the firm. And they've managed these transitions quite well. So we had a very well articulated succession plan on paper, and we put it into effect when Rajiv handed in his resignation. And that entailed Matt Bankendorf assuming leadership and rising to Chief Investment Officer. Now, Matt joined the firm in '99, was handpicked by Rajiv, and was his protege, all these years, and has risen through the ranks in terms of more responsibility, coming from an analyst up into managing portfolios as a full portfolio manager. And the other folks that you see here on the team, if you were to go back and look at the book we provided you 4.5 years ago, you're going to see a similar chart and with similar people. There have been a couple of additions, but no other subtractions. And each one of these individuals were handpicked by Rajiv. We've been always very careful to bring people into the team for 2 reasons. One, it's a very specific approach and view of how to manage money. We want people who buy into that. And you upset culture often when you bring people from the outside that aren't aligned that way. So was very selective. This team now has a tenure of over 10 years. Some have been now 15 years with the team. So Matt was a very logical successor. He stepped in quickly. What we did was a couple of things that I would say to you point to our ability to carry this on well into the future. One was Matt signed a 10-year contract with the firm with a 5-year non-compete. That was something that he asked to insert into his contract. His message being that I'm not leaving. He was essentially born in the firm. It was really his second job, so he's very committed to the firm and to serving our clients. The other team members were all given longer-term contracts with retention payments. So those will be gradual. Some were immediate. Some will be paid out over the next 3 to 5 years, assuming that, of course, that they stay with the firm. So that was important. We did that very quickly. He also nominated a number of individuals to become deputy PMs on the different strategies. For your strategy, there are 2 other PMs today, and that would be Daniel Cranston on the left side there, and David Sukar on the right in the same row. Both have been with the firm now for 2 years. Daniel, who we call Donnie, was a PM on our Europe strategy, so he was a natural to become one of the co-deputy PMs on this strategy. Now, the message there is 2 things. One, that this is where Matt differs, and you mentioned, a colleague of George's mentioned how no 2 PMs are alike, and certainly that is absolutely true. From a standpoint of managing money, they think alike, but as people, they're different. And Matt is not as wedded, if you will, to be the one and only name of Von Tobel on these portfolios. So he believes over time that he will begin to give others lead roles in these strategies. That was something that Rajiv did not do. So that presents huge opportunities for these individuals. They've been waiting for some time to step up and given this kind of responsibility. So there's a lot of enthusiasm and desire to continue carrying this forward, and that's important. That speaks of the morale of the firm, and the others as well. So others are on different strategies that we manage, but they're all managed the same way by the same team. None of that has changed. So our role is to help you achieve your long-term objectives. And the approach, if we now get into it a little bit, and what's happened in the portfolio has not changed. It will remain the same. And where you do see issues in performance, and this is pertinent to the other discussions you're having, is what happens with an investment style, through different market environments. So you have to ask yourself, is the portfolio suffering because of the market environment? We're out of favor style-wise, or is it something more insidious? So that's a very thin line. But often with good firms, I know Loomis Sayles for quite some time. They've been a very good competitor. They're what I would consider one of the stalwarts in the industry. They have a culture that will carry on, and an approach and style that they will remain true to. And I will say the same for us. So
I have to apologize.
Sure,
Step out.
absolutely.
There's no more votes required.
Are there any questions about the firm itself? I mean, I said a lot. Sure. So always, any follow-up questions occur, we're very transparent about what's going on in the firm. We're happy to provide any other information that you need. So very quickly, maybe just if you could turn to page 7, just to review what we are trying to do for you in this portfolio, and what drives us in managing these portfolios for our clients. And a few things stand out and have been long-standing. One, of course, is a longer-term focus. Investing is a tricky business. There's so much noise and volatility from month to month, day to day. But in order to achieve a long-term return that you need to build up your pension assets, it's absolutely incumbent to have a view that over time you will achieve this, despite what you might see in a short period of time in terms of markets going up and down and some portfolios not performing as well. We've seen that, and we have a perfect example here from the last quarter of last year, which affected our one-year performance, and what's happened in this quarter, and I will review that. And that requires patience, of course, right? It's very hard not to react to market activity. But when you have a philosophy that's anchored and a belief system that has proven itself over time, patience is key to staying the course.
So Jeff, how about let's jump right into that. Let's look at page 12 for example.
Great. That's what I was was my next page. Thanks.
Normally stable.
Mhm.
Great depth of team. Kind of, so much the same story. February meeting with Von Total on watch because of underperformance. Right? 2016 was a tough year. And then let's touch on page 12 as an example of kind of
Right.
we don't always expect this in the interest of full disclosure of immediate reward of patience, but what went on in the first quarter is certainly compelling.
Thank you. I appreciate that. And it is what I'll say a few things. One is the fourth quarter last year was devastating to this portfolio, but it was also true across what we know to be other similar managers that invest in somewhat of a similar style. And a lot of that was the effect that the election had here on the markets and what shifted, what the sentiment shifted. And that was very clear. Shifted from, okay, now we're going to have these businesses, infrastructure businesses, these companies that have not done very well the last few years because they're heavily indebted. They are cyclical businesses. And a lot of those are in sectors, industrial sectors, in material sectors, the commodity sectors. These have all suffered, quite a bit in the last few years. And we benefited as well by not being there. We saw that reverse, and the markets were extremely positive, and those companies, many of those sectors and companies with them just ran off. The three main sectors that we suffered in and we've been most invested in is consumer companies, financials, although financials did well after the election, but certain ones, and energy did very well. And those were for us, the biggest detractors in the fourth quarter. Consumer companies are a story in and of themselves. We've been big proponents of consumer companies across the globe. Speaks to a very long-term picture of what's happening around the world, particularly in the emerging markets, where you're seeing the growth of the middle class, and you're seeing so much of what occurred in this country in the 50s, post-war. You're seeing this kind of economic development around the world in most of the developing countries. In developed markets, it's been very difficult. U.S., Europe, Japan have struggled. U.S. is beginning to make a turn. If you look at what happened in the first quarter, those same three sectors that hurt us, the consumers, the financials, and the energy, were the best performing sectors in our portfolio in the first quarter. So there was literally a complete reversal. I think that, to your point, from our standpoint, of course, we were looking at the world. There's been a lot geopolitically that's affecting the markets. We tried to put that in the proper context because it doesn't really always have an impact on the market, on individual businesses. We try to be very, aware, risk averse in making sure this portfolio is not affected by these things. But we did exercise quite a lot of patience in holding on to these businesses. And a good example for us is Mexico, where we've had a good exposure for some time. Mexico, frankly, has been devastated by President Trump's remarks. The currency was down 10% just for the quarter, or from the election onward. That affected this portfolio quite a bit. Unfortunately, with international companies, you're going to have the currency sometimes be a big part of the performance. We measure everything in dollars, and we're always looking to make sure you get a return that will compensate for any currency weakness. But this was a period which was, if we reacted, we would have lost. We would have sold very, very low. We would have lost a lot of money, and we wouldn't have had the benefit of seeing the reversal in the first quarter. So that's what patience in investing really means. And we did, we do tweaks. We make tweaks around the margin in the portfolio. As I say, we're always trying to make sure that we keep the risk level low. But the core holdings in this portfolio have remained so for almost the better part of a decade. So we have a strong belief and conviction in most of the companies that we hold very big positions in. And those are the companies that did not change. So this is, in a very short period of time, you could say this is what this strategy and approach does. So in the fourth quarter, even though the year was a negative, the fourth quarter we participate in up markets as they go up. We typically will underperform these very hot markets, but on a relative basis, we still give you positive returns. When markets turn negative, this is when this approach really shines. And you see that on page 13 really is a perfect example year by year since the inception of your account. You know, we've had now 2 of these 4 and a quarter years underperform, and you know there's been some significant underperformance. But then you look at 2014, 2015, markets turned down, our portfolios remain positive. And in the markets, as I said, like 2013 was another good example, where we saw these reversals in sentiment in companies that did well that we didn't own, in sectors that we were not invested in, but we still provided a relatively decent high single-digit return, albeit in a market that was much stronger. And that is the essence of what to expect in this portfolio. And that also speaks to why I would say to you that going forward, this is still a strategy that will pay off. And the next page gives you a little bit of a picture of how that works and why can this portfolio can perform well in down markets and still participate well in up markets. So on page 14, these are 3 sets of returns. It's this strategy for the composite over a longer period of time on rolling periods, 3 months, 3 years, and 5 years. So we see the orange line is 3 months, and you see the volatility there. You see the spikes and the downdrafts. These are the markets where we invest in public companies. As much as we know that we have very solid businesses that are going to grow over long periods of time, they're still subject to to market sentiment. So you see a lot of volatility, and you see, if you look toward the end there, you see the spike down in 2016, the spike back up. But then you look at the 3 and 5 year numbers, the green and blue. They're much more steady over time. And they've remained, and we've achieved what we have seen in this strategy to be 200 to 300 basis points above the benchmark on a net basis. And so we've seen this in the past. We know that the portfolio can be resilient in tough times and do decently well in good times. And that's what we would say is the expectation going forward.
I think kind of looking at time and how long we've got schedules, I want to close out with page 21. It's one of the things that I was really interested in George and I were evaluating portfolios. One of my favorite stories that my dad tells. So I had a great uncle, passed away about 10 years ago. He was a dentist in Mount Clemens in like the 50s, 60s, and 70s. Worked like 6-7 days a week and like did really, really well. My great aunt, he was like gruff, just angry German. My aunt was like the sweetest woman in the world. My dad would tell me stories where they'd be at their cottage up in Port Austin, and he'd be doing the taxes every February and complain that my great aunt made more money than he did as a dentist just investing in the stock market. And her rule was, I got to know the name, like I got to buy the product, I understand it. So I use that same test, like and it's really easy from a domestic equity standpoint. You see names that you recognize. When you look at things from an international equity standpoint, and you take a look at the top 10 holdings on page 21, and whether you're a smoker or not, you see names like Philip Morris, British American, Anheuser-Busch, Unilever, MasterCard. These are all kind of household brands. And even when you dig deeper and you say, I have no idea who Reckitt, Benckiser is. Well, French's Mustard, Mucinex, if you're sick, Lysol, if you're also sick, or put my wife just sprayed all over my house because I've got 2 kids with the flu. So it's always, I think, a good test. Like when you talk about why we should have patience in a portfolio like this, and why we think 6 out of 10 of these companies I bought a product from or used a service from the last 2 weeks alone. So there's a lot of name recognition there and a lot of understanding. The flip side is if you want to say, what can I do as a trustee to help improve my portfolio? Go buy French's Mustard, maybe buy a Budweiser product, and like frequent the companies that you own in your portfolio.
And it's, I had my mother-in-law was the same type of investor, and she was brilliant. And it was just because she bought the companies and the products that she liked. And it is one of those maxims of investing, you know. So I really appreciate the point. And you know, these are our convictions. As I talked about our core holdings. They represent almost anywhere 35 to 40% of the portfolio at any time. These are the ones that we put the most of your money into, because these are the ones that are the steadiest of companies out there, and we know they're going to continue to grow. Now, when you look at names in other markets that are more domestic oriented, so emerging markets is still an important area of growth for international equity. And when we look at the companies that we own in these markets, they're very domestic driven, same characteristics. They just either it's financial services, which is very important right now in the development of many of these countries, or it's just consumer products that are sold directly into those markets. Same characteristics. This is what we look for around the globe. And we're very specific, we're very selective. This portfolio holds 50 names out of a very large universe of names out there. The benchmark alone is 1,900, but the available universe is closer to 20,000. So we don't believe that we have to be invested in everything. We just want to be invested in the best companies that will help you achieve your goals. So that's what we do on a regular, ongoing basis. And to wrap up, if I may, to give you a sense of why this will continue to work going forward. If we flip back to page 15, what drives these businesses are their operations, their earnings, the products they sell, the profits they make, and how well they're managed. And earnings growth is what drives the performance over time. Stock market moves up and down all the time. Those are the prices that people pay, but eventually those prices match up with earnings. And what do you want to do? What do you need? You need to compound returns from one year to the next on a steady basis. So this chart shows you the earnings of the portfolio in blue, and then the earnings of the benchmark in yellow. And on the left are going back in time. And if you two periods here, which is very very instructive right now. Well, first 2008. We all know what happened in 2008. Markets imploded. This portfolio still had positive earnings. And that's why we knew that over the next few years, this portfolio was going to do okay. We were storing value. 2016 is turning into a similar story, albeit in a positive environment. We underperform the market, but the earnings in these companies are out-earning the benchmark. So this in our view, bodes well for the next 2 to 3 years, at least. But we think in terms of 5 years and beyond. We're not short-term oriented in that regard. And that, I hope, gives you a sense of what's happened and how it's going to move forward. Again, I want to thank the board again very much and express our gratitude for sticking with us through this tough period, and really hope that you elect to retain us and that we will continue to provide you this kind of dignified returns for your beneficiaries. Thank you.
Thank you.
Thank you. We don't need to take any action or anything, right? We're just, yeah.
So
Yep.
the meeting's adjourned.
Okay. All right.
Did we have action to take?
Not only could
No,
we
we're just-
wanted to,
Well, we have a quorum.
we'll go before.
We need 4?
It's informational anyway.
Oh, okay.
So, that was just, there was
And there's nothing from our end from an action standpoint.
Okay.
Okay, yeah, we're just continuing the
Right.
watch list to end of June. So,
All right.
okay,
Meeting's adjourned. Thank you.
thanks, guys.